Welcome to our deep dive, and today we're going back in time a bit, dusting off a classic.
Yeah.
Warren Buffett's 1984 letter to Berkshire Hathaway shareholders.
Right.
Now, I know what you might be thinking.
Mm-hmm.
1984. Isn't that like ancient history in the financial world?
Yeah.
But trust me, Buffett's insights, they're like a fine wine.
Yeah.
They just get better with age.
Absolutely. This letter, it's not just a snapshot in time, it's really a masterclass in Buffett's investment philosophy. And it's full of these timeless principles that are just as relevant today as they were back then.
And he doesn't waste any time getting to the good stuff.
Right.
Right out of the gate, he calls Berkshire's 13.6% growth in book value mediocre.
Right.
Now, for most companies, that's a stellar year.
Oh, yeah.
But for Buffett, it just wasn't up to snuff.
Yeah, and that tells you everything you need to know about his mindset. Right? He's playing a different game than most investors.
Yeah.
He's not after those quick profits or trying to time the market year in and year out.
Right.
He's laser focused on building lasting value.
Mm-hmm.
And that takes patience and a long-term perspective.
So how does that translate into actual investment decisions?
Well, he dives deep into a few areas in this letter, and one that really jumped out to me was his take on share repurchases.
Right.
Or buybacks, as they're often called.
Yeah, and this is where Buffett's contrarian thinking really shines through. Back then, buybacks were often seen as a bit shady, a way for companies to manipulate their stock price. But Buffett flips the script. He argues that they can be incredibly beneficial for shareholders,
Okay.
but only under the right circumstances.
So what's the timing is everything. Buffett's point is that buybacks are only a slam dunk when a company's stock is trading significantly below its intrinsic value.
Okay.
Basically, what the business is actually worth. He uses examples like Geico, Washington Post, General Foods to illustrate how effective buybacks can be at boosting shareholder returns.
So it's like buying a dollar for 50 cents, but instead of a dollar, it's a piece of a fantastic business.
Exactly. And that leads us to another key takeaway from this letter. Buffett's unwavering commitment to ethical business practices. He goes out of his way to condemn practices like greenmail, where a company buys back its own shares at an inflated price from a corporate raider to prevent a hostile takeover.
So for those who aren't familiar with the term, greenmail is basically corporate extortion, right?
Precisely. And Buffett sees it as a betrayal of long-term shareholders for a quick fix. He'd much rather build a business that's fundamentally strong and valuable than resort to those kinds of tactics.
Yeah, you might expect a guy like Buffett to have a pretty straightforward bond investment strategy.
Right.
But buckle up, because he throws us a curveball.
Oh, he does. He really does. He doesn't view bonds simply as those fixed income instruments. He analyzes them through the same lens he uses for stocks as fractional ownership in a business.
So he's not just looking at the interest payments. He's digging into the underlying fundamentals, assessing the issuer's ability to generate cash flow, just like you would with a company.
Exactly. And this leads him to make some pretty contrarian bets. He talks about buying Washington Public Power Supply System bonds, WPPSS, or WHOOPS, as they came to be known.
Yeah, those bonds were considered incredibly risky at the time. The project was plagued by cost overruns, mismanagement.
Yeah.
Most investors were running for the hills.
Yeah, but Buffett saw an opportunity. He analyzed the situation and determined that the bonds were trading at a significant discount to their intrinsic value. Even with all the uncertainty, he compared it to buying a dollar for 50 cents, emphasizing that even with the added risk, the potential payoff was too good to pass up.
It's a powerful reminder that investing success often comes down to seeing value where others don't, even in the most unlikely of places.
Yeah.
But enough about the theoretical. Let's meet some of the characters who brought Buffett's investment philosophy to life.
Okay.
And there's no better place to start than with the legendary Rose Blumkin, or Mrs. B, as she was affectionately known.
Oh, Mrs. B.
The 91-year-old dynamo behind Nebraska Furniture Mart.
Right.
Now there's a woman who embodies the American dream.
Absolutely. She emigrated from Russia with nothing but grit and determination and built a retail empire on a foundation of hard work, honesty, and just this unwavering commitment to her customers.
And Buffett clearly admires her no-nonsense approach to business. He highlights how she built NFM on a simple but powerful philosophy. Sell cheap and tell the truth.
Yeah, it's a timeless formula for success. Mrs. B understood that if you offer quality products at unbeatable prices and treat your customers right, they'll keep coming back for more.
Speaking of simple yet powerful formulas,
Yes.
See's Candies takes a similar approach, but with a focus on quality and tradition over rock-bottom prices.
Right, and that creates its own set of challenges, as Buffett points out. He talks about the difficulties of maintaining growth in a seasonal business, especially when you're committed to quality over those quick fixes.
He contrasts C's approach with competitors who use preservatives to smooth out production and cut costs. C's, on the other hand, chooses to deal with the logistical headaches rather than compromise on the taste and quality of their product.
It's a great example of Buffett's long-term thinking. He's willing to accept some short-term inefficiencies to preserve the integrity of the brand and ultimately its long-term value.
And then there's the Buffalo Evening News, which offers a fascinating case study in the economics of a dominant local newspaper. Buffett argues that even a mediocre newspaper can be a cash cow if it owns the market.
Right. It all comes down to what he calls bulletin board value. Even if it's not, the New York Times people rely on their local paper for information, and that gives it pricing power and a captive audience for advertisers.
He does emphasize Berkshire's commitment to quality journalism, but he's also refreshingly candid about the economic realities of the industry.
Right. He backs up his claims with hard numbers, comparing the news-hole ratio, the percentage of the paper dedicated to actual news content with other papers its size. The news was way ahead of the curve, and that commitment to quality helped solidify its dominant position in the market.
He makes an interesting point, though, about how once a paper becomes dominant, its quality is almost beside the point.
Right.
Readers are kind of stuck with it.
Yeah.
It's a good reminder that market dominance isn't always a sign of a superior product.
Right.
Sometimes it's more about circumstance or strategic positioning.
Absolutely.
Now let's move on to something that can be a bit tricky even for seasoned investors.
Okay.
Insurance accounting. Insurance accounting. Not exactly the sexiest topic, I know. But when Warren Buffett talks about it, it's worth paying attention. And in this letter, he really pulls back the curtain on this complex industry, and more importantly, how he thinks about it.
What's really striking is his honesty. He doesn't shy away from the challenges of accurately estimating future losses, even admitting to some significant miscalculations he's made along the way.
Yeah, it's refreshing to hear that kind of candor from a CEO. I mean, he could have easily glossed over those mistakes, but instead, he owns up to them. It really speaks to his integrity.
Exactly. And that transparency, it builds trust with shareholders. He's leveling with them about the inherent uncertainty of the business, which is crucial in an industry where a single event can wipe out years of profits.
And he illustrates this with a brilliant anecdote about a rented suit.
Oh, yeah.
This seemingly small detail that ended up costing his insurance business a fortune.
Classic Buffett, right? He's such a master storyteller, and that anecdote, it perfectly captures the challenges of dealing with long-tail liabilities. Those hidden costs that can emerge years or even decades after the initial event.
It's like trying to predict the weather a decade out. You can make educated guesses, but there's always a chance you'll be caught with your umbrella down.
Right.
But here's the thing. Even with all that uncertainty, Buffett still sees insurance as a fantastic business.
Absolutely. And a big part of that is Berkshire's rock-solid financial position. He argues that their financial strength gives them a significant edge in the market, particularly in areas like structured settlements and loss reserve assumptions.
So explain that a bit further. Why is that such a big deal in the insurance world?
Okay, so think of it like this. When you're an insurer, you're essentially making a promise to pay out potentially huge sums of money years or even decades down the road.
Right.
So your financial stability is paramount. Berkshire's fortress balance sheet allows them to take on risks that other insurers wouldn't even consider.
So they're like the lender of last resort, stepping in when others are hesitant. But even with their conservative approach and financial strength, Buffett doesn't hold back when it comes to criticizing the bad actors in the industry.
Oh, no. He's especially scathing about insolvent companies that hide their true condition, essentially gambling with policyholders' money.
Wow.
He compares them to embezzlers hoping to hit it big and make everything right, but often just digging themselves into a deeper hole.
And he doesn't let regulators off the hook either. He calls out their slow response to these insolvent insurers, arguing that their inaction puts the entire industry at risk. Now let's move on to a topic that's always a hot-button issue for investors: dividends.
Yeah, and as you might expect, Buffett has a contrarian view here as well. He argues that dividends should be a last resort, paid out only if a company can't find a way to invest that money for higher returns within the business.
Which goes against the conventional wisdom of keeping shareholders happy with a steady stream of income.
Right. But Buffett is all about maximizing long-term value.
Yeah.
He sees no point in paying out dividends if that money can be compounded at a higher rate within the company.
Right.
To explain his thinking, he uses the analogy of a bondholder with a cash or reinvest option.
It's such a clear and elegant way to explain a complex concept. He's basically saying that if you wouldn't cash out a bond that's earning you a good return to put the money in a savings account, then you shouldn't blindly take a dividend if the company can reinvest those profits at a higher rate.
Precisely. And he doesn't mince words when criticizing CEOs who prioritize empire building or personal prestige projects over shareholder returns. He firmly believes that managers should be held accountable for how effectively they allocate capital.
It's all about being a good steward of shareholder money. If they can't find ways to reinvest earnings at attractive rates, they should give that money back to the owners, the shareholders, and let them decide what to do with it.
Exactly. And this brings us to another crucial point that Buffett emphasizes throughout the letter, this often overlooked danger of inflation.
It's like a hidden tax that silently erodes the value of your investments over time.
Precisely. And Buffett's been warning about its insidious effects for decades. He sees bonds as particularly vulnerable in an inflationary environment, especially when compared to owning businesses with pricing power.
Because those fixed bond payments lose their purchasing power as inflation eats away at the value of a dollar.
Right. But companies, particularly those with strong brands and the ability to raise prices, have a fighting chance of maintaining their profitability even when inflation heats up.
And this is where Buffett's thinking gets really interesting. He connects this whole aversion to dividends back to Berkshire's own history. Remember, this is a company that was built on acquiring and growing other businesses.
Right. In the early days, Berkshire was a bit of a financial life raft, you could say.
Oh,
Buffett and Munger, they were trying to escape some truly dreadful investments.
like what kind of investments are we talking about here?
Think textiles, department stores, even trading stamps.
Trading stamps. Talk about a business model that was ripe for disruption.
Right.
You have to wonder, what did Buffett see in those companies that everyone else missed?
It's a great question, but the point is they needed to find better ways to put their capital to work. Paying out dividends in those early days would have been like throwing money into a bonfire.
Yeah, it's a good reminder that every investment decision, even something as seemingly simple as a dividend, needs to be made within the context of the company's overall strategy and the opportunities that are available.
Absolutely. And as you read this letter, it's so clear that Buffett is constantly thinking about how to best allocate capital, both within Berkshire and in his own investment decisions.
And he's not afraid to admit that even Berkshire's incredible track record doesn't guarantee future success. In fact, he openly acknowledges that their returns on incremental capital are likely to decline as they get bigger.
Yeah, it's like the law of large numbers catching up with you. It's a lot easier to find those 10x returns when you're starting with $100 than when you're managing billions.
That's for sure. But even with that dose of realism, Buffett still sees a world of opportunities ahead, particularly in the insurance industry.
Yes. He paints this picture of a rapidly changing industry with premiums set to skyrocket, and many companies still reeling from past mistakes. Buffett sees this as a chance for Berkshire to really leverage their financial strength and their underwriting expertise.
So it's like they're the eye of the hurricane, calm, collected, and ready to capitalize while the competition is in turmoil.
Exactly. And that brings us back to, I think, the timeless wisdom of Buffett's 1984 letter.
Yeah.
It's about thinking like an owner.
Mm-hmm.
Focusing on intrinsic value over all that short-term noise, and being bold when others are fearful.
It's about having the discipline to stick to your principles even when they're not fashionable, and always being willing to learn and adapt to new information.
Right, and perhaps most importantly, it's about understanding that investing isn't just about picking stocks.
Mm-hmm.
It's about owning a piece of a business and participating in its long-term success.
So as you reflect on Buffett's insights, we leave you with this.
Mm-hmm.
What are the opportunities that others are overlooking today because they don't fit the conventional wisdom? What's your WKPFS bond? The investment that everyone else is afraid of, but you see as a potential game changer?
Yeah.
Until next time, keep diving deep.